Today in our Lunchtime Stock Club, we're going to take a look at the market, where we stand year to date. We're going to talk about whether or not a recession is headed our way, and we're going to take a look at a healthcare stock. And please, I welcome your questions along the way. First, let's take a look at where we stand in 2019 in the US and international stock markets. So here's a graph of our year-to-date performance of the three market segments that I track. The green line at the top is the Russell 2000. So after a rocky 2018, the Russell was out of the gate in 2019 and now stands up more than 13% year to date. The S&P 500 is not having a bad year. It's up 10.3% since the beginning of the year. And international markets have recovered as well after having a rocky 2018 as well, now stand at 8.4% gain for the year. So you can see it's been a pretty strong year. We had a little bit of a decline since the beginning of March. Last couple of weeks of February were some all-time highs for the Russell 2000, and those have fallen off a little bit, but as of this week, seem to be back on their way up. If we look at the S&P 500 PE ratio, you can see on the far right that it has declined a little bit. It had been as high as 24, greater than 24, and now it's back to about 21. That level is represented by that dotted red line on the graph, which shows you where this current PE ratio would have been in relation to many of the market stages in the past 100, 140, 150 years, going back to 1870. And so you can see that we are at an elevated status. Since the late 1990s, the PE ratios have been out of whack with the 1990s bull market that drove the average PE ratio of the S&P 500 up to higher than 40, and then as we saw the collapse of the market in 2008, 2009, we see the PEs kind of going off the scale there a little bit as the market dropped. But coming back from the end of the bear market in 2009, 2010, you can see that the P's had been edging upward and now have recovered a little bit. I think this is healthy. I think our current PE ratio still is a little elevated relative to history, but with interest rates so low, we're still relatively low. We're still in a phase where investors don't see a lot of other places to put their investable cash other than the stock market, and that helps provide a floor of support for the market and for those the PE ratios of many companies, which remain rather elevated. The big story is that the earnings of the S&P 500 continue to increase. Got a little boost in 2017 from the Tax Reform Act, which boosted earnings by reducing taxes. That's not really a reason to give executives bonuses, but it does push the chart ever higher. And you can see the S&P 500 earnings on a trailing 12-month basis right now stand at just over $130, and that is an all-time high. So that bodes well for the PE of the market and driving stock prices forward. If earnings continue to support stock prices, then that is good all the way around. But today, the Swiss bank UBS upgraded the likelihood of a US recession. And so I thought I would talk a little bit about recessions in the classes that I teach around the country. I often talk about the history of recessions and expansions in the US economy, as well as the bear and bull market cycles. And I think that understanding how these cycles operate can really contribute to your success in the stock market. So I thought this was very interesting that they upgraded the likelihood of a US recession from 24%, which is where it stood in December 2018, to 73%. So they're saying there's a 73% likelihood that the US will enter a recession in 2019. Now, the latest GDP release was better than expected. The GDP is estimated by the Federal Reserve, and then it's adjusted when the actual data comes in, and They analyzed a little bit further, and so the final release was a little bit better than expected, but UBS pointed to some problem areas. One was that the first was that spending on durables, and so this includes furnishings, household equipment, recreational goods, is down the greatest amount since 2009. This is not surprising if you're following any of the RV stocks that we cover in our small cap Informer, companies like Winnebago and LCI. They've been struggling with softer demand, and so UBS is pointing to this trend as being somewhat problematic, also pointing to spending on services that's down the greatest amount since 2012. There's additionally weakness in the housing market. I think that the weakness in the housing market, my position is that it's in pockets of the housing market, especially with higher priced homes, that there's a lot of strength still left in the first time entry-level home building segment in residential construction areas. But when you look at housing in the aggregate, it is showing a little bit of softness. UBS also points out that the US-China tariffs are expected, in their view, to do more damage than has been playing out in recent months. So they're expecting the impact of those tariffs to worsen. And so, again, hopes are that we can get some sort of resolution to this issue. There's still a lot of uncertainty, and there's still a lot of downside from a lot of the tariffs that have been enacted. Job losses in key manufacturing states have gone up, even though unemployment is still pretty low. We're beginning to see the manufacturing segment cut some jobs. Maybe they're looking ahead and trying to be proactive so they don't get caught short if spending continues to decline. The domestic demand growth in the fourth quarter was half the pace of the third quarter, another warning sign, and UBS points to confidence indexes that have dropped substantially. So consumers are that level of uncertainty is kind of creeping in. We've been dealing with uncertainty in the market and in the economy for several years now, and that hasn't really shaken out. As has been pointed out, and as I've mentioned, one of the problems with our current recovery, and that's going since March 2009, is that it's never been a perfect recovery. We've never had all cylinders firing all at once, and so there's always something that's slowing, something that's slipping, something that's causing the bears to point to and hold out as weakness in the economy. But overall, things have continued to move in an upward direction, and so that is one of the problems of the current recovery. And I think UBS could be accused by some quarters of pointing out the weakness in selected areas while ignoring the strength in others. But it's certainly worthy of a headline and certainly worthy of consideration. Just to review, here is a chart of U.S. recession since 1967. This comes from the Federal Reserve Bank of St. Louis. So you can see the red and blue lines there indicate the periods of recessions, and you can see if you split this graph in the middle around about 1980, 90, between 80 and 90, you can see prior to 1990, the recessions were much more frequent, and then on the right side of the graph from 1990 through today, we've had 3 recessions since 1990, and the big market crash in 2001 and the end of the dot-com boom. That recession was very short-lived. Our Great Recession of 2000 that ended in 2009 was a little bit longer, but the periods of expansion, which are the white areas in between the bars on the chart, have been getting longer and longer and longer. And I think, if we think about all of the causes of expansion and contraction of the economy. We think about what's happening in manufacturing with trends like just-in-time inventory, better forecasting tools, then you can see that across the spectrum of industries and businesses, there's a lot more intelligence and up-to-date information that companies and management can act on. And so I think that kind of pushes out the prospects of a recession a little bit further. It's just helping everyone to kind of navigate the uncertainty with just a little bit more information, and over the aggregate over time, that helps push out the incidence of recessions to a greater extent. According to the National Bureau of Economic Research, the NBER, the present expansion of the economy began in June of 2009, and what the interesting thing about recessions is and expansions is that we don't know we're in them until 3 months after, 3 quarters after they've started. So typically the definition is that when we have 3 quarters of declining GDP, we're in a recession. When we have 3 quarters of expanding, after that, we are in an expansion. And so in September 2010, the NBER announced that they believe that the economy reached a trough in June of 2009, and that was the end of the recession that started in December 2007. So we've been, since June 2009, in expansion mode. So in just a couple of months, we'll be celebrating, hopefully we'll be celebrating the 10th year of the present expansion, and that is historically quite long, and that is cause for, again, for the bearish to point to the longevity of that expansion, and that becomes case number 1 for why the expansion can't continue for very much longer. I don't buy into that. I think we have to look at the fundamentals, and if you look at some of the other data, like the Federal Reserve Bank of St. Louis, and this is again as of March 1st, they calculate the probabilities of a U.S. recession, and they, on a 0 to 100% scale, and you can see they've plotted those recession probabilities against the gray areas, which indicate the actual recessions. And so sometimes the recession probability, as in the early 2000s, we had a slight recession, and there was the recession probabilities calculated by the Federal Reserve Bank was only just about 30%. Other times the probability gets much higher. But the important thing is that as of March 1st, using data as through December 2018, the probability of a U.S. recession, as determined by the Federal Reserve Bank of St. Louis, is 0.28%, which is very, very, very low. It's not even a blip that you can see on this particular graph. So according to the Fed, they continue to see the economy as is moving along in a positive direction, and not in imminent in an imminent state of collapse in terms of the start of another recession. Well, of course, we don't invest in only in expansions and only in recessions. So from our perspective, it is just another point that we add to our information toolbox. We continue to strive to invest in both good weather and bad weather by diversifying our portfolio, by maintaining exposure to stocks in consumer defensive industries, as well as cyclical and sensitive sectors and industries. And that is something that we can do to help protect our portfolio when the current expansion does end. Many companies, when the expansion does end, will expect a lot of large cap cyclical companies to see their prices drop as their sales kind of fall off. And that makes it a little harder for us to analyze those businesses. But again, I think the takeaway is that people talk about recessions all the time, but recessions always end. Recessions tend not to be very long. And if we try to second guess when a recession might be coming along, we can miss out on the expansion. And certainly there have been people who have been afraid of recessions coming for several years, and yet the economy keeps chugging along. And so there's just some thoughts on where we stand from the point of people who pay attention to the economy and economists. As President Truman famously said, he wished he had a one-armed economist so that he wouldn't always be saying "on the other hand," because economists tend to have multiple viewpoints. My view is that even if we do have a recession, it'll be over within a year or a year and a half, and then we'll be back in growth phase. It's just kind of a necessary adjustment to production and services output, and it's a natural part of the economic cycle. I see the lengthening of the expansion mode as being positive. Kind of frees us up from having to grapple with sudden downturns. In 100 years ago, the cycles were much shorter, and so you would have periods of expansion that were only a couple of years long, followed by a couple of years of contraction or recession, and that made it very difficult to run a business if you're constantly fighting the demands of the marketplace and declining demand for whatever product or good or service you were manufacturing. So that's my take on where we stand right now in March 2019. Again, a recession could happen. It will happen at some point. It could happen in the next couple of months, but we won't know until we've got a couple of quarters of declining GDP. So there will be some warning signs. And that's why you'll hear people saying that they believe we've entered a recession after one or two declining quarters. But if the market recovers after that, we won't technically be in a recession. And the National Bureau of Economic Research does look at all of the data and makes the official determination for what it's worth about where we stand in the economy. I wanted to point out that it's following daylight savings time, which went into effect yesterday. We have come up with a special offer on our StockCentral web tool. This is a subscription service, and our special for our daylight savings time special offer is for a 2-year subscription, and we're throwing in a free printed copy of our Take Stock book, which is a great primer on investment analysis using a better investing style approach. If you're not familiar with StockCentral, we have stock analysis tools like a Take Stock analysis tool that's similar to the Stock Selection Guide, has some additional features and functionality, and is actually good for beginners. It will calculate things and provide suggested judgment as you go through it. We also have a ratio analyzer, which digs deeper into several dozen financial ratios, looking at the balance sheet as well as the income statement. We have a stock screener that's very straightforward and easy to use. We have message boards, sector and industry averages, and company data reports, and a technical price chart application for those who want to dig into technicals a little bit further. So it kind of goes above and beyond what's available from Better Investing, above and beyond what's available in Toolkit, and it's all web-based. This offer is available. If you go to the iClub.com website, it's on the home page, and that will give you the link to subscribe. If you subscribed annually at full price, it would be $181. The Take Stock book is $29.95. So we're giving you 2 years plus the book for $139.99 plus $6.95 shipping and handling for the printed copy of the Take Stock book. So I wanted to push that out there if you're interested in that offer. We don't do a lot of special offers for StockCentral. So this is really your opportunity to check out the website and join our community there of investors who are using the tools made by Better Investing and iClub Central and looking for long-term opportunities in the stock market. So let's talk next about a small cap stock to study. This is a small company. It's technically a mid cap stock, as they often are. But this is a pick from our investor advisory service newsletter. It's Supernus Pharmaceuticals. The ticker is SUPN. This is a specialty drug manufacturer. They focus on treatments in an area that's fairly targeted for epilepsy, migraines, ADHD, impulse aggression, and bipolar disorder. It was featured first in IS back in March of 2018. It was $37 at the time. In March 2019, the analysts took a look at it and said, this company's made a year's worth of progress and the price is the same. This looks to be a great opportunity. So they picked it up in the March 2019 issue, which came out the last week of February. It was $37.45 at the time. Today or Friday, it closed at $37.61. The revenue for fiscal 2018 was $408 million. The current PE is 18.3. Our IS analysts were projecting 25% earnings growth over the next 5 years. And let's talk about that and see how reasonable that might be. Here's what you need to know about the company. They've got 2 drugs that treat epilepsy and migraines, Oxtellar and Trokendi, and XR stands for extended release. So these are reformulations of drugs that they developed previously and provide some additional longer-term benefits for those who are suffering from those afflictions. In the pipeline, and this is where you get a little bit of uncertainty, but the pipeline from our perspective of our IS analysts looks pretty strong. They have 2 late-stage drugs targeting impulse aggression, IA, and bipolar disorder. And those drugs are in testing phase, and there will be more data available in the first half of 2019. They've got another new treatment for attention deficit hyperactivity disorder. They are also testing the use of their Oxtellar XR for bipolar disorder, and they have a new drug for impulse aggression and juvenile ADHD called SPN 810 that is in development as well. So that is that last drug is being tested right now, and if it works for that juvenile ADHD impulse aggression market, there could be other uses for it that could be investigated by the company. If you look at the history, sales have grown very nicely. We focus on the period since 2014 when growth sort of leveled out and normalized a little bit. So growth has been very consistent over the last 5 years, reaching $408 million. Profits and earnings have been moving upward as well to reach $2.05. So what is causing the company's price to not keep pace with earnings and sales growth over the long term? And I think in the view of our analysts, it's simply because the pipeline that I described, it's got various drugs and various levels of testing. The market is undervaluing it. They are not, don't quite see the potential there. They've discounted the potential. They're bracing for worst case scenarios. They're pricing for none of the drugs to have any commercial success whatsoever. And so this sort of overall negativity in our view is driving down the prices. I'll flip over to my toolkit just to give you another perspective on it. I've plotted here the sales and earnings estimates from the analysts who follow the company for the next 2 fiscal years, and you can see the red dotted line represents the 20% sales growth. And I've knocked down the earnings growth from 25% to 20% for the sake of this presentation. I feel like 20% is fine, but you can see that by 2020, the analyst estimates are for much higher growth, slightly higher. The growth is above that 20% projection line. If I flip over and we take a look at the analyst estimates as aggregated on Yahoo Finance, it's got good coverage. There are 9 analysts covering it over the next 2 years, and those estimates for 2019 range from 205 to 250. For 2020, the estimates range from 237 to 413, with that average estimate being 327. So there's some analysts that are a lot more optimistic, and there are some analysts that are a little more pessimistic. If we scroll down all the way, the growth estimates for the next 5 years, I'll grab let me grab my arrow key here. The next 5 years, average annual growth is 37% from analysts that are tracking growth over the next 5 years. So this 20 to 25% expectation that our analysts are looking for, that I covered in my stock study here that I'm presenting, could be very conservative, and so I think that gives us perhaps a little bit of additional upside. And you can see the current price is represented here by the red, the red line. It's on the low side of the 52-week high and low, and it's really not much above the lowest price of 2018. Of course, that low price was reached in December during the Christmas Eve sell-off. So you saw SUPN went down to as low as $30. So really, that was not driven by fundamentals. That was just the market going a little crazy at the end of the year. And so since it's recovered, picked back up that $7 from $30. So incredible buy at the end of the year, as were many of the stocks in the marketplace. So Joe's asking on this graph, why is there a gap between earnings and pre-tax profit? In this case, they're moving in sync, with the exception of that 2016 year where earnings jumped up a bit. If we put on the shares outstanding, so there they are. So that could be part of the tax adjustment for 2017 if they had a benefit or a gain. But for me, everything is moving in sync more or less, and so with the exception of that 1 year. I don't follow the company closely. Our analysts aren't concerned about that. It hasn't come up in any of the write-ups there. Growth estimates, Alice, what do we mean by growth estimates? We're talking about our projected earnings per share and revenue growth growth projections over the next 5 years on an annualized basis. So when we talk about 20% earnings and sales growth, we're talking about 20% per year for sales and earnings, and potentially on the upside. Now, as I mentioned, our analysts in the March issue projected 20% sales growth and 25% earnings growth. And the reason for that is because of the expansion of the pre-tax profit margin. So you can see the profit margin has been increasing, and as this margin increases, the earnings will increase faster than pre-tax profits. So this is the pre-tax profit margin, the percentage of profits before taxes as a percentage of revenue. So you can see in 2018, those pre-tax profit margins were at an all-time high, close to 35%. You can also see that prior to 2014, the margins were, the company was not making money at that point. Which is, again, this is fine. This is a smaller, more aggressive business, but we look at that as a very strong trend and an uptrend. You can compare this. I don't think that margin analysis on a pre-tax basis, when compared to different drug manufacturers, even in the specialty generics business industry segment, is particularly apt because every company's portfolio is different. They've got different drugs treating different applications. Some are going to be widespread and there's going to be competition. Others are going to be unique treatments that for which there's not a lot of competition or generic alternatives. And so margins are going to vary significantly. However, if you do look at a company like Eagle Pharmaceuticals that we covered in our small cap informer, you'll see that Supernus does have much more attractive margins by and large than Eagle, which is a maker of generic drugs, and so that's going to be a lower margin business as you go through there. If we look at the back, the high PE based on 2018 data, so the company reported last week. So based on the full 2018 data, in this analysis, the high PE is 27, earnings expected to reach 510 per share in 5 years, which would deliver a high price of $138. On the low side, the PE has been, the average selected low PE is 15.9. Earnings in the last 52 weeks were $2.06, which gives you $32.80 as a low price from the current price of $37.61. That's in the buy zone with an upside downside ratio of 20.9 to 1. Again, that's pretty excessive. If you bump up the earnings per share growth to 25%, it becomes even higher, and the compound annual total return is close to 30%. There indicated at the bottom. So again, that's a very aggressive stock selection guide. But in the viewpoint of our analysts, they believe that the pipeline value justifies a much higher multiple, and just a couple of successes coming out of that pipeline will result in a much higher valuation. So, so in other words, later this year, some of these drugs move through the FDA approvals process and testing process, and just a little bit of success will cause quite a bit of capital appreciation in the stock price. So that's the viewpoint. Again, you can be a little more conservative if you wish, but it looks like the downside is all pretty much built in. The existing drugs look like they're able to deliver revenue of $500 million a year over the or that's the company's estimate of the peak sales for the two drugs that it's already got. And so $500 million in peak sales from current sales of $408 million means that there is some built-in upside, even if the pipeline isn't as successful as the company seems to believe that it is. So this just gives you a starting point for analysis and for some thinking about the particular business. This particular pick was featured on March 1st on moneyshow.com. If you go there, look in their investing and trading section. If you search for my name, Gerlach, you'll find a bunch of small cap informer and investor advisory service picks, and Supernus was pulled out and featured on March 1st. So you can read a little bit more of the analysis from the March issue of the newsletter and the subsequent earnings release for the fourth quarter. I'll flip back over to my toolkit. And as we look at the P ratios, you can see a couple of years where they were much higher. So they've really been all over the map. In the last 52 weeks, they've been as high as 29 and as low as 14. So that kind of, and that's in a very muted period of earnings power for the company. So a lot of investors not really taking the company's prospects to heart. So again, you can work with these numbers, do a little additional research, but hopefully it's a stock that might be of interest to you. A healthcare stock like this would be considered a defensive stock if you were considering the defensive section of your portfolio and you were wanted to prepare for that coming recession to come a little bit sooner rather than later. You might want to be sure to beef up the defensive section of your portfolio, and this is one small cap that kind of fits into the market. Eric asked why the debt went up so recently. Yeah, if you look at the debt to equity, it looks like this is first year is completely out of whack in 2013, but when we look at 2018, it was 75% of equity. So I think there are opportunistic borrowers and in a low interest rate environment, but I don't know the specific use of it. But again, that's something that's pretty easy to figure out. They've been so underloaded on debt for so long that didn't seem to be raise any warning signs in the analysis. 43% of debt, 43% of total capital is debt as of the end of the fiscal year. So a little bit of an increase in debt, and again, that might concern some people, but do your own due diligence and figure it out why you do. If you are interested in the investor advisory service, if you're not currently a subscriber, there's a promo code you can use, 9 for 9, that celebrates our 9th year of being on the Holbert Digest investment newsletter honor roll for outperforming the market in every bull and bear market cycle since the late 1990s. So use 9 for 9. That will get you an attractive rate on that particular newsletter if you want to check it out. So questions there. Terrence asks about the StockCentral screener, and he ran the top 20 stocks through over the weekend. The only one that was recommended was NVIDIA, and it said the price was too high. In other words, the take stock tool is very conservative, and I hardly ever see it recommend to buy, and that's absolutely true. On StockCentral, we do have our roster of quality companies, and we have our take stock screening, take stock analysis tool. And if you use the take stock analysis tool and on a regular basis, so we'll go ahead and look at NVIDIA. So here is the example of the company report. Down below is kind of interesting. You can see the growth rates of all of the different factors there, and the actual 52-week high and low PE ratios down below. But I'll go ahead and click on Take Stock. This is our interactive tool. There we go. And so Take Stock was designed as a one-click instant analysis tool. And it is designed for beginners, especially to help protect them from making mistakes, from overpaying for companies. The problem is that in the last few years, many companies have been very expensive, and that has caused quite a bit of difficulty in finding reasonably priced companies according to better investing rules, according to the company's own historical ranges of high and low PE ratios. And so it's typical that you'll come up with a quality index of 6.3. And again, that's very strong. We like to see anything above 3.4 or better on a scale of 0 to 10 is a good quality index. So 6.3 is very good. The mood indicator, investors believe this company is worth about what it's been worth in the past. So in other words, the mood indicator appears to be fairly reasonable, but the current price appears to be about $38.99 too high at $111. Well, so as you use the tool, you can drill down through it. So the quality index is made up of the growth index and the efficiency indicator. The growth index looks at the sales and earnings growth. And so you can see green is good, yellow is less good, red is negative. So the historical growth of sales is adequate. and the historical earnings growth over the last 5 years is excellent, as you can see there. If we jump to the efficiency indicator, both the profit margins and the return on equity appear to be up. So the language on the screen and the indicators give us a clue. Again, you can track this. We're now in section 2 of the stock selection guide. The mood is all about the valuation, and so reasonable investors are paying approximately what they have in the past. We look at the buy price. That's when things get a little bit uncertain. If you want to achieve a desirable return, at least 14.9% or better on an annual basis, then Take Stock is suggesting that 111.65 is the highest price that you should pay for it, and that if you pay more than that, the potential high price the program is showing is $219. So anything above 111 is limiting your potential upside as you go forward. You can look at the total return at the current price. So if you decided to buy it right now, Take Stock is suggesting that you only get a slightly more than 8% annual return from the current price, and the risk is very high. So 48.7%. So that is much higher than desirable. There's also a Take Stock or a Technimental stock study worksheet that, again, looks like many of the aspects of the stock selection guide. So here's a graph of pre-tax profit as in section 2. Again, just about improvements just about every year, at least stable or rising, and return on equity is also increasing nicely. When you flip over to the back, then you'll see the PE ratios. Up here, we can see the high and low PE ratios. Here are the years. So you can see in 2018, the PE ratio was as high as 44 and as low as 18. I'll highlight these lines. And you can see that some of them are crossed off. Take Stock is looking at the mean, not the average, so it's eliminating the highest and the highest highs and the lowest lows to determine the mean PE ratio on the high side and the low side over the last few years. And so the current, at that current PE ratio the average PE ratio that the program is looking for is around 23, and so currently it's much higher than that, or it's right around there. So it's suggesting that on a valuation basis, it appears to be good. And so the rest of this is just kind of a rehashing of our stock selection guide. You can also print an SSG from here. So in the case of a user who knows what they're doing, you can click on the judgment wizard, and you can step through and you can make adjustments, and you can see the criteria and the judgment that the program is assigning. And so it's suggesting right away that the stock is priced too high. As we click next and we go through it, you can see here how predictable is earnings growth, and the program is suggesting it's somewhat predictable. It's not very predictable because we had 1, 2, 3, 4 years where the earnings were essentially flat, and then they went on an upturn again, and so that's not very predictable. But they are still moving generally in the right direction. So the program is suggesting it's somewhat predictable. You can make your own assessment there. And you click next. We're looking at the strength of earnings, and so the program will calculate relevant growth of earnings and sales. So it will take out outliers, eliminate outliers. It's suggesting the growth is moderate based on that sales growth of 14.1%. And if you took out, I might even take out, we'll see ways that you can make adjustments to it later. 14.9 is a desirable growth rate for companies from Take Stock's perspective, and so sales growing on an annual basis of 14.1% falls below it, which is why the program says it's moderate growth. And so here's where we can make our estimate of sales and earnings growth. Take Stock is working on a 20% growth rate. Sales might be a little bit less than that. that would be a very high rate of sales for the company to grow based on their historical growth. It looks like earnings could continue to grow at that rate. So I'll stick with this take stock estimate over here. This is why you might look for growth to be, earnings growth of 20% might be supported by 14% revenue growth because the margins are moving upward. So we can make our own assessment there. But yeah, I don't think you would argue that the margins are even or trending upward. One decline in 2013, but they've come back. And again, this is coming back from a negative. But again, we point out this would be during a recession, so maybe that there's some cyclicality to this particular stock. The high P ratio is all over the map. Here's the estimated. Here are the high and low PE ratios on the graph, and here's where Take Stock is estimating growth. The P ratio should be relative to the earnings growth and history of the company. If we look at the 5-year average of 38, the 10-year average high PE of 31, or the Take Stock estimate of 23, here's where you can make an adjustment. If you believe that NVIDIA will warrant in 5 years a PE ratio higher than 23, maybe you're saying, well, if they're growing at 20% a year, they could support a PE of 30. Well, here's where your chance to override that judgment. And so we'll type in 30, we'll update the graph, and now here's our selected PE ratio. And that's going to adjust our judgment of the high price, the low price, what this company is likely to achieve. Let's see if we can see the results on the backside. It's saying now the buy price is closer to 132.91 as opposed to 111 that it was before. So it's providing some additional upside potential to the particular company. Let me, did I refresh it out of the way? There we go. And so the current price is still 150, still a little high. The next thing that you can go through are the judgment tabs over here. And this is sort of the expert user where you can step through all the judgment based on these 5 tabs as you go through here, and you can review and you can evaluate what you expect earnings to be, the PE ratios, the growth rates, et cetera. And then in the end, you can look at the summary. You can also look at the SSG, and it might give you, again, a slightly higher perspective. So based on that higher PE ratio, already we're seeing the price in the buy zone, because now the buy zone goes up to $162 and 22% total return, 3.7 to 1 upside downside ratio. So this is all part of the tool. And why I've walked through it very quickly, but now you can see all of the stuff that's on the back end, all the features that we don't present to beginners when they're getting started. Then you just enter in the ticker symbol, and let's use another one. We'll go ahead and use our Supurnas just because, and it's saying that the fundamentals don't justify a purchase at this time. And again, that's the limitation of the tool. It's looking at it's below our 3.4 rating on the growth because the past growth has been less predictable, less stable. The growth rate, when you calculate all of the data, the percentages are very high, but there's also a high degree of inconsistency. Efficiency is good, mood is cool, buy price can't be calculated, and that's when you would turn to the wizard. So that's just a bit about the tool. When you're on any screen, you click the concepts button, it pulls up a little description of the tool, and there's also a user guide that will explain more of it as you go through. And you can step through and it will talk about all of the different features and what happens as you drill down. And so that's also inline help that's available there. So yes, the short answer, Very few companies look attractive out of the gate in the current environment because of the overall high PE ratios and valuations placed on many companies. But if you are experienced and want to adjust the judgment, you can review the items individually, reset the judgment, and add your own values. And that's part of the value of the tool. Christian says, does this come with StockCentral? Is that extra? This is part of our StockCentral tool suite, is the Take Stock. It's the core. When we look at things like the growth index and the efficiency index, and if we go on the home screen, this quality index, that's what we use throughout our tools, calculated by a similar method to Take Stock. So we have our own Take Stock quality index, which wraps up the growth and margins analysis into one figure. 0 to 3.4 is undesirable, 3.4 to 6.6 is acceptable, and 6.7 or higher is desirable. And that's based on the 5-year history and the pre-tax profit margin trend. Harvey says, is there a plan to update to Toolkit 6 for 2019? At this point, we don't have any plans to update it, but that could change based on any number of factors. Right now, there's no plans to update Toolkit. We've generally been doing one update a year. Sometimes that's been driven by external factors. And so at this point, there's nothing on the horizon. We won't be in any case, we wouldn't be making any significant changes to the functionality of the program at this point. Toolkit 6 is on the last legs of its expected lifespan, and so we won't be expecting to release any major new features to the Toolkit 6 program. Okay, well, let's wrap it up. I want to thank you for coming out to our Stock Club today. Here's a quick overview of my schedule for the rest of 2019 as it stands now, with events in Florida, Ohio, Iowa, Chicago, Seattle, San Francisco, Philadelphia, Orlando, and back to Philadelphia. You'll notice there's 2 new money shows this year. Brand new money show is going to be in Seattle in June and Philadelphia in September. And so those will be your opportunity, if you live in those areas, to check out the money show, get exposure to all sorts of interesting investing ideas, trading, speculating, gold, cannabis, not just stocks. They cover the full spectrum, so there's some entertainment value as well as education value from that particular environment. And then Al points out in the Puget Sound Investor Education Conference in November 9th. And yes, I did offer to return to that event. So that's, again, another trip to Seattle in November for their annual conference, which is one of the biggest in the country, put on by a Better Investing chapter. Well, I want to thank you for coming out tonight, today. We'll look forward to seeing you not in April, not in May, but in June at our next Lunchtime Stock Club webinar. Thanks very much. And I wish you the best for your personal and club portfolios over the next couple of months as well. We'll look forward to seeing you at the next one of our events.